So good morning, everyone. Welcome back to our weekly webinar series. This time, I believe we are talking about a fresh subject. 1st February is when we had the union budget, and today we are talking about it. Of course, we have with us Anil sir, and today we also have with us Mohit Gupta, who's a chartered accountant and expert in transfer pricing and international taxation. So I believe we can have some opening remarks from Anil sir, and we can start.
Thank you, Ankit. Welcome to our 44th episode. And although we thought that we will focus on the impact of budget on insolvency and SURFACE, which is our main subject, but then after looking at the budget, we couldn't see much to speak about on impact on IBC or SURFACE. So therefore, the today's episode would be a mixture of whatever impact it would have on the insolvency profession, insolvency professionals, IBC. But then most of the time we will also add to the other features of the budget, which may be some of the very, very important amendments to income tax and the international transactions scenario. CA Mohit Gupta is appearing for the first time with us in AAA webinar series. Welcome, Mohit, and I hope that the audience would like your deliberations on a very, very specialized subject. The screen will be shared by Ankit today, and I would be giving my comments, and Mohit would be doing his specialized role today. So Ankit, you can continue with this screen sharing. In between, your voice is not audible.
It should be okay now. I had muted.
When you unmute, it takes some time.
Yeah, I think that was happening previously also, but I think it should be all good now. So let's start, and we will start with two provisions in the union budget which are related to the restructuring or with respect to union budget. So let's start with that process. So section 170A, this is a provision which basically talked about how a business organization or the effect of an order of tribunal can be placed or can be accessed to by the assessee. So the old provision looked something like this, where we talked about how it kind of gave a non-obstante clause overriding section 139 with respect to the filing of returns, and then said that in case of business reorganization, where prior to date of order of a high court or a tribunal or an adjudicating authority, there the return of income could have been updated or could be filed again by the successor under the provisions of section 139. And this was basically this could be done within a period of 6 months from the end of the month in which the order was issued. And there the modified return could have been filed by the person who is the successor. So let's see the changes that they have introduced. So in the new provision, they have once said that they have given this whole process, whether it is the order of the High Court or the tribunal or the adjudicating authority and so on, they have said that this is the order in respect of business reorganization. And they have then said that wherever it has been any return of income that has been furnished by an entity that can be refiled or updated or modified by the successor. They have also then introduced all these new provisions into the same section, where they say that where the assessment or reassessment proceedings for an assessment year relevant to previous year to which the order in respect of business reorganization applies has been completed on the date of furnishing of the modified return in accordance with provisions of subsection 1, the assessing officer shall pass an order modifying the total income of the relevant assessment year determined in such assessment or reassessment in accordance with such order and taking into account the modified return so furnished. Then it says that wherever the assessment or reassessment proceedings are pending on the date of furnishing of the modified return, then the assessing officer shall pass an order assessing or reassessing the total income of the relevant assessment year in accordance with the order of the business reorganization and taking into account the modified return so furnished. So save as otherwise provided in the section, then it says in an assessment or reassessment made in respect of the assessment year under this section, all other provisions of this act shall apply and the tax shall be chargeable at the rate of taxes as applicable to such assessment year. So this is the change that they have made. So building in some provisions with respect to how the modified return then can be taken up. Just a second, just a second.
I
So,
I can add on this, Ankit. So first of all, this section 170 capital A is applicable to resolution plans also, because the resolution plans are also a restructuring according to the Income Tax Act. Now, the successor in this case will be resolution applicant, successful resolution applicant. Now, the successful resolution applicant can see that what are the returns which were filed earlier by the RP or before the earlier management. And if there is any modification required based on the resolution plan, then the returns can be modified. So earlier, the modification process was already there and it was also inserted in Finance Bill 2022, but the process was not defined. Now they have defined the process of assessment also. Is that correct, Ankit?
yes, perfectly right.
Yes, you can go ahead.
So the next part is the decriminalization of Section 276A. Now, this is the extract from the memorandum, and here it says that Section 276A of the Act makes provisions for prosecution with rigorous imprisonment of 2 years in case of a person being a liquidator fails to give notice in accordance with Section 178 or fails to set aside the amount as required by subsection 3 and so on. Then it says that it has been the stated policy of the government to decriminalize minor offences as a step towards improving ease of business. In this regard, the provisions of the Act have been examined. Section 276A provides a prosecution of liquidator for non-compliance with Section 178. Section also imposes personal liability on such liquidator for the same non-compliance. So further, in operationalization of IBC, waterfall mechanism for payment of dues is now in place for companies under liquidation in subsection 6 of 178. The parent section provides that this section shall not have effect when provisions of IBC are in contrary. Moreover, the liquidator is now working under the oversight of this specific law. Then it says, in view of this, it is proposed to amend Section 276A by providing a sunset clause on the section with effect from 31/3/2013. Hence, it is proposed that the fresh prosecution cannot be launched under this section after 1/4/2023. So I think it's a welcome step. Must be some feedback which has gone to the finance department from IBC or from IBBI, that this is a section that can maybe open doors to some kind of prosecution for liquidators under IBC and then can have some disputes, especially where the liquidator is having a conflict with the income tax department with respect to what are the rights of the income tax department in the waterfall mechanism, which is again something which we have talked about in the sales tax officer judgment. Your views?
No, I think this is a common effort that the government is making for decriminalization of Companies Act, decriminalization of the finance, and also in the IBC, the decriminalization has also been proposed in the proposed amendment by way of a notice issued by MCA on 18th January 2023. So in that also, there are many such prosecutions which are now would be dealt by way of a penalty. So this decriminalization is not really effective because it takes a lot of time in adjudication. So therefore, the government is now focused on penalizing rather than prosecution. So I think this is all good in line of the circumstances in the country. judicial delays in giving such orders of prosecution.
Right. So let's move on to the provisions that have been introduced otherwise, some good decisions that have been taken to make a better tax administration possible. So I think Mohit can also join in wherever he feels he wants to add something. And insertion of the Joint Commissioner appeal as an office to ease the burden of CIT appeal is a process that they have started. In this budget speech, it was conveyed that over 100 joint commissioners are planned, and these joint commissioners will also, like, it is also expected that they will work under the mechanism of the faceless appeal system, and they will be taking care of maybe smaller amounts, or rather the disputes which are arising from the orders of assessing officers below the rank of Joint Commissioner. They have reactivated the section 246, which was suspended in the year 2000. So maybe, practitioners who were practicing before 2000 can remember how this Joint Commissioner appeal system used to work. But yes, this has been restarted because of the limitation of how many CIT appeals are available to take up all the appellate matters, and of course the kind of time and effort it requires to handle a CIT appeal matter. We are all acquainted with the overburdened CIT appeals office and the pending appeals pending with the CIT appeal for a long time now. Then there is a commitment from the FM made in the parliament in the budget speech that the average time for processing the returns was reduced drastically to, I think, about some few days. And she has now made commitment that the average processing time will be reduced to 24 hours for financial year in the next financial year. There was a dilemma, or there was a process that was causing a practical issue. So when a company files their returns and claim TDS, which they can officially claim, or rather legally claim only that TDS where the income has been disclosed. So the changes have already made in the ITR forms to carry forward TDS, which was deducted in the previous year by maybe the recipient of services or goods at the other side of the assessee, but then that TDS could have been carried forward and then claimed in the year in which the income is declared. Now there was instances where the opposite is happening, that somebody has declared income on accrual basis in some year and the TDS has not been deducted by the other party. Maybe it's an entity which has not yet recognized the expense, and it recognizes the expense only in the next year or the next year or so on. So there now they have introduced a system within section 155 read with 154, where you can apply for rectification and in respect refund of the TDS to be granted to you, where the return was processed, you had already paid self-assessment tax, or maybe you had paid the tax which was applicable on that year through your other TDS available to you, and you had borne that tax already. So now you can make an application under section 155 with 154 and claim that TDS that has been now appearing in the future years to the year of that assessment, to that assessment year. Then, of course, they have talked about a new gen IT form. The IT form is now a very dynamic IT form. It is actually on the system. So now they have talked about a new gen IT form and a grievance redressal system, which will be common to all people. So maybe, this year when the forms are released, or maybe next year, we will see how the form is now a common form and we don't have 1, 2, and all that number of forms. Although when we are using, as professionals, when we are filing returns, we are normally using softwares, and those softwares are normally selecting the forms automatically. But the government is, I think, making an effort to make the ITR form user friendly to the extent where the forms can be filed by the individual assessees themselves rather than going to a professional. So that is again something that this kind of a revised form will help.
So Ankit, although you said that, maybe about 20 years back, there used to be a hierarchy, but now this has come back. So, but then these TDS provisions are in most of our insolvency professionals or even other professional brothers, they probably would be using it the most, because see, when someone is working with large organizations like banks and financial institutions, we are not sure when they would recognize our bills. And since the bills have been issued, the GST invoicing has been done, we would take those bills into our income and we would pay taxes. So in the subsequent years, when they uh, process those bills and they make the payment, they deduct the taxes. So the income has been declared before, the TDS has been deducted later on. So this scenario was very much required for insolvency professionals, because the most of the time it happens that we have to issue invoice because we have to uh, get this CIRP cost approved based on the timelines during the CIRP period or during the liquidation period. We also have to pay our fee, a fee of the IP, fee of the IPE, regulatory fee to IBBI. So there are multiple things that we have to coordinate. One, the declaration before GST authorities, declaration before the IBBI and IPA regarding our income and the fee payable to them, regulatory fee in case we are appointed as professionals in any of the process. And we are never sure. In some cases, we get our payment after 3 years or 4 years. But like in case, sometimes we reverse the invoices in case we don't get the payment. But then there are many people, they are not able to do that, because see, that might even become some kind of uncertainty over the CIRP cost. Because see, we are claiming CIRP cost continuously in all the meetings, and in case we reverse it, then it might even become a little problem. So all this is definitely very, very useful for all the professionals who are recognizing the income, issuing the invoices before their TDS is deducted. And that has to be claimed now under Section 155, that the particular TDS which is deducted now in this year, where the income was declared a year back or even 2 years back, that has to be given as refund to me. But there is a separate process. It could have been simplified, but yes, it is definitely, it was required for professionals like insolvency professionals or even other professionals, uh, because the payments are not certain. Yes, Ankit.
So then they have now the thought process is clear from the government that they introduced a new scheme. They wanted the new scheme to be followed by most people. But yes, there I believe is still some gap in that expectation. So this year they have really made the new scheme very, very attractive. One, they have reduced the slabs. They have completely removed the 25% slab. And in effect, they have given to anyone who is a non-salaried person having 15 lakhs of income, the reduction in tax in the new scheme itself as compared to the previous scheme is 39,000 in actual tax. And then for a salaried person, they have even added the benefit of standard deduction in the new scheme. So for somebody who is earning 15.5 lakhs, the tax benefit is rising to 52,500 rupees. So the idea is that then the other change that has happened is that there was a provision under section rebate under section 87A, which provided that in case somebody has an income of up to 5 lakh rupees, then that person is not supposed to pay any tax at all. So the whatever tax was being computed based on the rates was exempted under 80, was given as a rebate under 87A, and therefore the person used to pay no tax at all. So that 5 lakh rupee limit continues to be 5 lakh for the old scheme, but now it is 7 lakh for the new scheme. So with standard deduction, now the tax-free income that somebody can say that no TDS is applicable to me if that person's total income is 7.5 lakh rupees or less. So this is a big change as compared to 5 lakh rupees, which was earlier the norm. Uh, the second thing that is applicable now is that the higher surcharge of 37%, which used to come into effect as soon as somebody used to earn more than 5 crore rupees, has been relaxed, but has been relaxed only for the new scheme. So my interpretation of all these actions is that one, the overall tax impact on individuals who are earning up to 7 lakh rupees, 7.5 lakh rupees, salaried people up to 7.5 lakh rupees, up to 15 lakh rupees also, and rather everyone at all, because these numbers, when they change, will make the new scheme more attractive. Also, the total income that is declared under various scheme is also the target of the government. So maybe next year the government will say that since 90% of the people have opted the new scheme, or rather only 10%, because now they have also removed the condition to opt for the new scheme. So now you will have to opt for the old scheme, and new scheme will be by default. So now what will happen is that maybe next year there will be a basis to discontinue the old scheme at all when the numbers of people or the total income which is disclosed under the old scheme declines considerably. So that is the idea, and all these benefits have therefore been given the old scheme. So who are the people who will have a lesser benefit? They will maybe the people who are having a high HRA benefit that they're already taking, people who are getting some kind of a disability allowance because of the provisions in the earlier law. So all the provisions that are not applicable to the new scheme, people who are taking benefit of those provisions will then not be able to maybe exercise or use these benefits in case their threshold is still not getting crossed to enjoy these benefits. Then more changes. 44AD, there's a provision for presumptive income that if you have a total receipt of up to 2 crore rupees, you can declare 8% profit of your cash income and 6% of your income in check. And that has been increased to 3 crores, subject to the condition that the total cash revenue should be less than 5%. Similar changes have been made in 44ADA for professionals, where professionals having up to 50 lakhs of income were eligible to say that they will declare 50% of their income as presumptive income, and they were able to then pay tax on that 50% of the income. Now the total threshold for that has been increased to 75 lakhs, and again the condition will be there that up to for 75 lakh rupee income, up to 75 lakh rupee income, you have to then have a cash revenue of less than 5%. Otherwise, you have to get yourself audited. So that is the
There
provision.
is a special question that I can have, because one, I would like to add that this increase of 50 lakhs limit to 75 lakhs with a condition that not more than 5% would be in cash, that's it, definitely will give some benefit to professionals. One, the specific question is that is this particular section 44 ADA applicable to valuers also? Because I'm not sure whether that has been specified by the central government by way of a notification. I know that it is applicable to all other professionals, and the only thing is that the valuers have not really, because see, otherwise in solvency professionals,
Most values are
valuers.
professionals in other capacities. So if the professionals, I believe, also includes engineers and technical people. So I think they're professionals in that capacity. So they kind of get included, although it is not specified.
So then see, like, because it is already there, it is the engineers and the like interior decorators, architects. So they are qualified people, so they can avail this 75 lakhs. So in case their income is 75 lakhs, their turnover is 75 lakhs. So their income can be a minimum income can be 37.5 lakhs without any expenditure. No further expenditure would be allowed, not even the depreciation would be allowed. Then the other information, like, yes, somebody can definitely declare more than this. But Ankit, what are the so far case laws available? Like in case, say, somebody say that he has kept this entire or 75%, 75 lakhs of income in the bank account, or maybe that he has incurred only few expenditures out of it. Would that entire 75 lakhs of rupees or even 70 lakhs of rupees, in case he claims 5 lakhs of rupees expenditure, would be considered as his legitimate capital?
So
So
far, I have
I
not
would
come
say that,
across, yeah, maybe Mohit
see,
can
like,
add more, but so far I have not come across any litigation which kind of challenges that. Maybe Mohit can also
So
add here.
I think that's the law is very clear. So, sir, they say 44 ADA you can claim if you are a professional, and simple 50% of the income of the total revenue would be taxable.
They're
no, see,
not concerned with what is
I'm
the
only saying
expenditure.
very,
So
very
they are not.
specific.
There is no ambiguity here. So they have given a flat rate of 50%. So let's say 75 lakhs is my entire income from professional fees. So 50% of that makes it 37.5 that I have to offer to tax.
The offering to tax is absolutely fine, but then
Yes.
the balance 70 lakhs of rupees or entire 75 lakhs of rupees in my bank account. And if I invest that money anywhere in the bonds or in the mutual funds, would that be my legitimate capital?
No, that would be considered as your income from other sources. If you're earning any other, so if you have
No, I'm
invested
not saying that. I'm not saying that.
Okay.
I'm saying 75 lakhs has been received in my bank account.
Question, yeah.
And I have declared an income of 37 and a half. And in case I invest that 75 lakhs rupees entirely to mutual funds, would that entire money would be considered as legitimate money?
Yes.
Because see, I have declared an income of 37 and a half.
Yes.
My capital generation has been 75
lakhs. Yes.
But I believe that when we file the income tax return, do they also ask for my fund flow or cash flow while the returns under section 44 ADA are filed?
No, not in my knowledge.
Nothing like that.
Right.
So basically the only issue there that I find is that if somebody has genuine professional income coming his way, then that shouldn't be a problem. But wherever I believe, I always think that wherever you have a some assessing officer can establish that the 75 lakh rupee revenue is coming in from related parties, or rather, in the way that somebody is under a tax audit and then he's giving 75 lakh rupees to a relative, and that relative is then using presumptive income to say pay lesser tax. So those kind of operations might come into some kind of a litigation. But otherwise, as long as the professional income is coming from third parties, I don't see any problem with this provision being used.
No, I can even because this all belongs to our professional audience. We have too many professionals presently engaged with us in this webinar. I'm saying that think of a situation that somebody tries to misuse this section 44 ADA. He has some income in cash and he has some income in check. So whatever expenditure that he's incurring, he's incurring those expenditures in cash, and whatever amount that he's receiving by check, he's keeping in his bank account. But still he's paying tax on the 50% only. Yeah. So is it legitimate?
Yeah, I think so far there is no case law which is against it.
After 10 years, a person says that I have 7.50 crore as capital, and can the income tax department say that you have paid tax only on 3.75 crores and your capital is 7.5 crore, and it is challengeable? Is there any judgment, Mohit or Ankit?
So what we can do is we can park this question. Okay. And I think in the next session for the larger audience, if we find something or we can share our thoughts, so let's do that in the next, I think, let me do some research work on it. This is a very good question you have asked. So I think we should do
in fact, this is disturbing me since years. And I have seen many of my professional friends, they've been doing it regularly, consistently. And today they may have in their bank account 5 crores of rupees, but they have paid tax only on 2.5 crores. 2.5 crores. And that too in the last 10 years. And this is something that I need to understand in case of any future raid, any future search, any case of any future investigation. Would the entire income would be considered as legitimate income? Entire capital would be considered as a legitimate capital? That's very, very important question that I definitely would like our audience to know. Yes, Ankit, please go ahead.
So there have been then other changes. Leave encashment, the limit has been increased to 3 lakhs. So it was 3 lakhs for a long time. So it has been increased to 25 lakhs. So those who are getting leave encashment at the end of their retirement can then have a tax benefit on the 25 lakh rupees that they get as leave encashment up to that amount. So 15% tax rate is introduced for cooperative societies, very similar to the rate that is already available to manufacturing companies. So manufacturing cooperatives can also now exercise the same scheme. There is almost no change in the scheme, which is already available for the companies in this respect. TDS on taxable part of EPF has been reduced to 20% from 30% because they must have felt that this is causing a reverse tax issue. Going forward, proceeds from insurance policies, they tweaked the ULIP part last year. Now they have tweaked the policies also. So for policies where the premium will be more than 5 lakhs, these are future policies, not older policies, where the total premium that you're paying is more than 5 lakhs per year. There the money will be taxable if it comes in the hands of the policy holder. and it will be exempt only if that money is received by the nominee after the death of the insured. So it will curtail the HNIs or the ultra rich to then park their money and then get benefits of the insurance policy, which is having exempt income under this section. There is also a limit that has now been placed on 54 and 54F. This is a section that again has been used because it provides for a system where you can have a capital gain, and rather than paying 20% capital gain on long-term gains, you can use this section, buy another residential house, and then kind of keep changing or keep investing in new residential houses every 3 years, therefore providing for no tax on the capital gains on the residential property investments. So this has been limited to 10 crores of benefit. So in case now you sell your house or you sell investments under 54F and you're buying a residential house, and the purchase of that residential house is consuming capital gain tax of more than 10 crore rupees, then the limit under 54 or 54F for benefit to you will be limited to 10 crores. So big change for the larger properties or the more expensive properties that used to be sold. This 10 crores, in my opinion, is for per SSE. But there have been differences here in the interpretation that 10 crores is per property or per SSE. In my opinion, it is per SSE.
That's a very important clarification which is required. So what we have seen so far in our practice of income tax, that every year assessee buy or sell the properties, and especially residential houses under section 54. I'm not talking about section 54F because that's a different. Under section 54, you can sell property, you can buy property. It should be a residential house, and there is no limit on the number of residential house under this section 54. Is that correct, Ankit?
Very much.
Yes.
So like this has been a kind of misuse, that most of the people, they've been investing in residential houses, residential flats, and they're using the section 54. And in case you would see that some people might have used 100 crores of exemption under section 54 over the years. Now, if it is 10 crores per year, or it is 10 crores overall per assessee, and if it is overall per assessee,
10 crores per assessee per year, or 10 crores per house per year? That is the question.
I think if it's a house per year, then the whole purpose of bringing the cap would dilute.
So I think it is 10 crores per assessee per
no,
year.
it should be 10 crore per assessee per year.
Yes.
But that only means that you can still continue to sell 20 houses in a year, buy 21 houses in a year, provided the only issue is that it should be 23, it should be long term. It should not be short term.
It has to capture the other conditions of 54.
It's section 54. Other conditions are 54, that it should be a long-term asset.
Yes.
And if it's a long-term asset, you can have 20 houses. You can sell 20 houses, you can buy 20 houses, and still you can continue to examine, and this you can do every year.
Yes, yes.
But this I think this should have been brought to the government, that this particular thing is actually being misused by high net worth individuals, and the objective of
there's a step towards that. So I think once they've brought in this 10 crore limit, now they will perhaps tweak this later.
Scrutiny, I think. Yes, there'll be more scrutiny around it now.
They'll tweak this more. So I think this is going to happen.
Right.
The other big change, the next one is very interesting. Now, there was this big dispute, and the government was trying to tax lottery and gambling, and there is a peak high rate or fixed rate of 30%, which is taxed there. And they were trying to tax all these Dream 11 and all these games of skill that have been claimed to be games of skills. So now they have made a new section and says that the moment there is online gaming, you have to deduct TDS at the rate of 30%, and the gains out of online gaming are taxable at 30%. Even if a person does not withdraw the money from the gaming account or from the account with the service provider, if they have made gains during the year, then TDS will be deducted at 30% and the tax will be required to be paid. So big change for all the Dream 11 players who were using their skills on Dream 11. So now the skill, the revenue from the skill is taxable.
I seek one clarification on this also. Like you have said that even if you don't withdraw from the account, now that means that in case I have made 10 bets in a day, and I have earned on 5 bets and I have lost on 5 bets, So the 5 bets that I have earned, in all those 5 bets, 30% TDS would be deducted. Is that right? Or it is not the...
This is the net income made
Okay.
by somebody in the entire year. So how it will work and how they have envisaged the sections is that say you play and you make some gains and you withdraw those gains. So in case the withdrawal is more than 10,000 rupees, then you pay TDS or the TDS is applicable on the withdrawal. But let's say you keep the money in the account and you play again and you incur some losses. And then net gain is no longer there in that financial year. In that case, there is no TDS. So basically, the point is that the taxability or the TDS reduction is either at withdrawal or at the end of the year on your net gain during the entire year.
Yeah, yes.
Okay.
Then they have made this big change where people who were making LRS payments abroad for either purchase of property or other overseas tour packages, they were paying 5% TCS. They have increased this to a 20% TCS. So the only 0.5%, 5% is only left for education and medical treatments. 0.5% is still applicable where somebody has taken a loan for education. That remittance is still at 0.5. 5% is for other than any loan. If you're remitting it for education or medical purposes, it will still have 5% TCS. Anything else, including overseas tour packages or any other remittance that you make under LRS, you have to pay a TCS of 20%. I think this is a big change. A lot of people who are sending money overseas will now be accountable and they will have to address the source of their money, and this whole information or the tax will be captured by the government. Then they have, of course, removed the exemption on the income of a notified news agency, which was a provision under 1022B. So any news agency which is working now has to pay tax. Increasing further the tax base, so REITs and InvITs, there were certain methods being used for repayment of debt, which was not being offered to tax. Now it has been made taxable, minor changes. There was these instruments of debentures which were being used for, which was market-linked debentures, which were used to trade in actual equities through an SPV. And there again, they have said that this trading of this debenture will not be long-term capital gain, it will be short-term capital gain, to rather put them in the same bucket as equity trading. Listed debentures, there was an old provision, I think this was introduced about 10 years back. I remember this being introduced in one of the budgets, that TDS will not be applicable on listed debentures or interest on listed debentures. They have changed that so that this also is captured in the returns automatically. And of course, they have then tweaked the regulations or sections on rent-free accommodation, allowing the government to prescribe methods of computation of taxable perquisite. This is also expected to increase the perquisite taxability for rent-free accommodation. Let's see how the rules are framed, however. They have done something in ATG where they have removed these 3 legacy funds called Jawaharlal Nehru Fund, then Indira Gandhi Fund, and Rajiv Gandhi Fund from the list of exemptions. So again, something which they have only retained the PM fund.
The method of calculating the perquisite value of rent-free accommodation specifically for government, whether it is to their benefit or it is
current provisions used to talk about how the government will have to, if the employer is the government, there was a separate rule. If the employer was other than government, there was a separate rule, separate section. This is how it was structured. So now they have said that they will simply refer to rules to ascertain the taxability of that rent-free accommodation. The rules will provide for how the government accommodation, other accommodations the value will be determined.
So rules will be notified.
In the
then
course
only
of time.
we'll see whether it is beneficial or it's like loss to them.
We see this being used where companies own residential properties and then the company is given them as an RFA to the directors for 20 years, 25 years. So I think there might be an intention to tweak that.
Right.
So going forward, they have increased the time limit for scrutiny assessments. We had 9 months from the end of the year. Now they have asked for 12 months. So once again, the date for scrutiny assessment or the ending the scrutiny assessment becomes March from December, which was proposed earlier. They've extended the time period to 24 months in case of in case of surveys and searches and so on. So that is also available. New provision for audit of inventory has been inserted, allowing cost accountants to audit inventory in a similar way special audits are being done by chartered accountants or impaneled chartered accountants. They have increased some time limits for the settlement board decisions that they were taking. They have then added a section, or rather, there were some litigations perhaps where the department was taking assistance from all these experts, but maybe there was a litigation which was hampering that. So they have modified section 132, allowing the government or allowing the income tax department to officially use digital forensic professionals, valuers other than the registered valuers under the Income Tax Act, archive experts, locksmiths, carpenters, etc. for search and seizure processes.
So, Ankit, I would like to add a few points here. So, I was interacting with one of the commissioner of foreign assets and investigation wing. So, this move has been welcomed by even the tax officers are also appreciating this move. So, they could welcome professional like us whenever they required, especially valuers or tax experts or any specific things, any specific topic. If they're engineers also, they could hire to understand the things better. So, this is a really welcome section, I think, for professionals.
Section is pretty open-ended. Section is pretty open-ended. It rather does not limit to locksmiths, carpenters,
Yes.
etc. It kind of opens the ambit for any expert to be hired by the IT department to take care of, to assist them in the 132 process.
See, for professionals like chartered accountants, GST experts, or valuers, earlier also it was provided in the law. I think what they have added is the digital forensic valuers, professionals, locksmiths, carpenters, archive experts. This is what they've added. Because these are some things which actually have been challenged by some assessees that the department doesn't have power to bring digital forensic professionals when they go for search and seizure.
It was earlier limited to police and impaneled valuers. So I think they have extended that now. They've modified the same section to include these experts as well, or rather to include other experts. So startups and micro enterprises, they have introduced this provision in 43B, big step for small and micro enterprises, not for medium enterprises, only for small and micro enterprises, where they have said that the deduction will be allowed under income tax for the expense incurred where the payment was made to a small or micro expense enterprise only if the actual payment is made. So that is how they have put that. They have also talked about extending the...
Yeah. No, this is something which is very, very important. I would like to take 2-3 minutes on this amendment. So first of all, this particular benefit has been given to micro and small enterprises, not to MSME. Now, what is the present limit of micro and small? The micro and small present limit is that for a micro enterprises, the investment in plant and machinery should not exceed 1 crore and the turnover should not exceed 5 crores in the last year. Secondly, for small enterprises, this investment in plant and machinery is 10 crores and the limit for turnover is 50 crores. Medium enterprises, this benefit is not available. Also, in fact, Reserve Bank of India has come out with a notification that how the value of plant and machinery will be calculated and how the turnover would be calculated. And like as far as this value for plant and machinery is concerned, the return on value as per the income tax return would be taken as the base. That is the value that will be considered for giving you a status of micro or small, and the turnover will be excluding GST, and the turnover will also exclude export. So when we see these things, then we also see that this particular section, these two sections, medium and small, this is only applicable to manufacturing organizations or service providers. It is presently not applicable to trading. The trading organizations actually would get the benefit of MSME only for the purpose of bank loans and not for the purpose of these benefits. Now, what this benefit is restricted to? This benefit is restricted to one, all the professionals, all service providers, all manufacturers.
Yeah.
Now, but this is a very, very important that in case within 15 days the payment is not made, it will never be allowed as income tax deduction. Second, in case the deduction is not in case of any agreed payment period, which cannot be more than 45 days as per an agreement. Now, for example, a purchase order says that the payment will be made after 60 days. That is not valid for the MSME organizations. So for anything which is any payment which is not made after 45 days, that is something which will never be allowed, and that will be deducted, that will be disallowed forever, because the proviso to section 43B is not really applicable to this particular clause. So this is a very, very big effort by the government to help MSME. And in fact, there are many people, they've been talking about it, and now nobody is saying that it is a big, very big effort to give a benefit to especially the small and micro enterprises. The important part is all our professional brothers, they can use this. We are all service providers, may it be a chartered accountant, valuer, or an insolvency professional, or an advocate. We are all service providers, and in case our payment is not being released, he will have to pay, and then it will never be allowed as an expenditure, not in the next year also. So this is what I wanted to add.
Perfect. So let's go forward. So some penal provisions, let me just quickly go through it because we are short on time. So gifts which were received or sent by residents to non-residents were taxable under a deemed fiction under section 9. Now gifts received from residents by residents but not ordinary residents are also covered in that provision. Cost of acquisition, there was always this big question, or cost of acquisition, can you include interest that you have paid on your cost of acquisition, and you have maybe used that as deduction under section 24B or chapter 6A. Can you use it to add it in cost of acquisition as well? So they have said that no, you can't. Going forward, the cost of acquisition will only include the interest to the extent it is not already claimed under 24B or chapter 6A. Then notified authorities, there was this judgment in the case of Ahmedabad Development Authority where they had disputed the whole idea that how can you have a charitable institution who is making profit out of housing accommodation. So DDAs and all the housing development agencies were becoming taxable in that deeming because of that case law. So they have now notified, brought in a separate section 1046A to deal with that and provided exemption to authorities who are providing or who are engaged in business or in work for need for housing accommodation. Charitable institutions, a lot of changes. Like last year, they modified a lot in charitable entities. They have done a lot of changes this year as well. Charitable entities can accumulate funds which they are not able to spend for a specific purpose, which they need to then spend within 5 years. This time limit was along with the due date of the ITR. They have now changed the time limit to 2 months before the due date of the ITR. So effectively now you will have to make this deposit by August 2023. So it is effective from this year as well. There was this small problem with feasibility report, project report. There was this unnecessary requirement to register a vendor with the board. So they have removed that and now kind of made it a self-declaration form. Cost of acquisition for any self-generated intangible asset, there were some case laws which were talking about how the cost can be claimed. They have now clarified and said that this will be nil. Changes in custom duty, I believe I can skip this slide in the interest of time. Proposed changes in GST, a few big changes. They have now said that the composition scheme the composition scheme was not being used by many people because composition scheme did not allow suppliers of goods or services, goods through electronic commerce to exercise composition scheme. So now they have removed that linkage. So composition scheme opters will now also be able to effectively then go to electronic commerce operators and sell through them. Input credit on CSR expenditure, there was this question, dispute, or whether it is restricted or not restricted. So they have now proposed to make it restricted. Effectively, it is a window that in case somebody has not been claiming input credit for CSR expenditure, he can claim it now till the time this change is notified. Requirement for persons providing only exempt service, there was a problem in the how the sections were structured, where combined reading could give an interpretation that even if somebody is providing completely exempt services, he would be required to get registered because he is taxable under reverse charge. So now they have removed that anomaly. Provisions to be made for making of rules to limit interest. So the government has been paying huge interest amounts on delay in GST refunds. So now they will come out with some rules which will have a system to identify the reason for delay. So income tax already has that in case the government is able to establish that the reason for delay is the assessees, because there was a demand notice and the assessee resolved the demand only in 5 months. So the 5 months interest will not be paid to that person. So they will maybe bring in similar rules to limit the interest on delayed GST refunds. Interesting provision that they've changed. So they've now talked about how sharing of information which is already available in GST returns, e-invoices system, e-way bill can now be shared with third parties. So I think this is a step which is towards one. I feel that there is a use case scenario here where if the buyer and the seller give consent to invoices being transferred automatically from the GST portal to the IU, or to some kind of a factoring agency or some kind of a loan agency, then that will be a avenue which will allow technical platforms to kind of operate this interchangeability and use it to get financing, or rather also build cases where the actual invoicing has happened. So therefore, I think IU is a big case where IU will get this information in case the supplier and the recipient say yes. OIDR, they have increased the scope. So with this, I am ending my presentation and
Like
allowing then
one small
Mohit
thing that I
to
would
share
like
his
to
screen. Yeah.
one small thing that I would like to add regarding this, again, benefit to the MSME and even the other organization for a delayed payment. Now, what they have done is that in case one invoice is issued by the supplier and the customer takes the input tax credit but doesn't pay for it. Earlier, it was only like after 6 months, he will have to reverse the ITC. Now he will have to reverse the ITC and he will have to pay interest on that. So this is a change. This is a welcome change. So you can't do that because see, like you are not paying and you are availing the input tax credit. No, it has to be refunded. It has to be refunded back, and that too with interest. I'm not
But
sure.
the
I have
interest, but the interest will not go to the person who has paid GST on raising the invoice. It will be kept by the department.
yes, it will be. But then the person who actually has
Use the
paid
input.
GST, he only will get the reversal of it. Yeah, I
So
think.
Mohit, you
Yeah.
can share your screen and then you can continue with the.
I'll just do that again. You have to select this like this. Check.
So you can go to view and make it full
Yes,
screen.
I think is a
It is visible anyway.
yeah, okay. Okay. Let's start with proposals made in transfer pricing and international taxation in the unit budget 2023. Let's start. Okay. The first and the foremost proposal made by the finance minister during the budget was reduction in time limit for submission of transfer pricing documentation. The time limit to furnish information under Section 92 has been reduced from 30 days to 10 days, which on an application made by the assessee can be further extended by a period not exceeding 30 days. So in case the transfer pricing officer earlier, when they used to issue a notice, so assessee used to get 30 days. Now that time limit has reduced from 30 to 10 days. So now it has become very imperative for the taxpayer who has entered into international transaction and specified domestic transaction to maintain transfer pricing documentation on or before the filing of Form 3CB. Earlier, we have seen, if I have to share my experience, generally what happens is the assessees, they have this laid back attitude. He said, let's go ahead and filing of Form 3CB. We'll get the transfer pricing report prepared in due course of time. Now, after this change in time limit, it's very imperative for the taxpayer to maintain TP documentation in a timely fashion manner in order to avoid stringent penalty provisions. I think this is what 92B talks about. And then, okay, after that we have that. Yes. The second amendment made in the transfer pricing provisions were extension in the scope of specified domestic transaction. Any transaction between two domestic entities which are related, and if one of the entities is having a concessional tax rate of 15%, in that case, the provisions of specified domestic transaction would get triggered. In this budget, since they have extended this provision to new manufacturing cooperative society, now they'll get a tax benefit of 15%. So in that case, SDT would be applicable on them. This is very important, because earlier we think transfer pricing provisions are only applicable on international transactions. Now we have to be really cognizant of this fact. If there is a SDT and the threshold provided by the government is 20 crores. So if you have a transaction, domestic transactions between two entities, where one of them is having a concessional tax rate, in that case, we have to file Form 3CB and we have to maintain transfer pricing documentation on or before the due date of filing of Form 3CB. Okay, this one is a little tricky one, Section 94B, which talks about thin capitalization. This section says if any Indian company or a permanent establishment of a foreign company has taken loan from a non-resident, in that case, there is a cap. So the amount of interest which is allowable under the head PGBP is only 30% of EBITDA. So now they have given some relaxation to NBFCs who are engaged in the business of lending and borrowing of money. So they have given that exclusion. So this is a welcoming move for NBFC, those who are engaged in lending and borrowing of money. This is the last one, applicability of Section 56(2) subsection 6B. So earlier this section was applicable only to resident. Now they have extended the scope to a non-resident. So in case investment is made by a non-resident investor in excess of prescribed fair market value of shares, it would be taxable in the hands of Indian company under the head income from other sources. So this here I would like Ankit, you and sir to give your opinion, because I think the scope for valuation has certainly increased.
Scope of valuation has increased for sure, but then it also puts everyone into a fix. Now, earlier there was a distinction that income tax used to say that if you allot shares to a resident, then of course we will say that whatever is coming in excess of the fair value, we will tax it. Now, the trouble is that in case you're also adding non-residents there, then FEMA says that in case it is not allowed that you bring in money or allot shares to somebody and bring in money which is less than the fair value. So there you are trapped in FEMA, because FEMA says, how can you sell Indian assets for less than their fair value and then cause foreign exchange loss to the government? There, the fair value is then computed under FEMA currently by chartered accountants or merchant bankers, or I believe these are the two authorities that are prescribed there. And practicing cost accountants as well.
Okay, I have one more question here. So we talk about Rule 11 UA when it comes to valuation of unquoted shares. So only a chart account. So it's only a registered valuer can do that, or a chart accountant can also sign those 11 UA.
11 UA for this purpose, for 56(2)(7)(b), the current rule is that in case you're allotting equity shares, then equity shares have to be valued and can be valued only and only by a merchant banker to comply with the income tax provisions. But in case you are allotting other than equity shares, sometimes you issue convertible preference shares, sometimes you issue convertible debentures and so on, those securities can be valued by a chartered accountant or a merchant banker. Okay. That's the present state of 11 UA.
Okay.
However, there is an internal department notification also now, how the department and FSD has said that let's adopt registered valuers concept across the board. But then we have not seen that happen, because when we are talking about this section 56(2)(7)(b), we are only and only talking about shares being valued for the share issue being valued. Now, that has to involve a company, but the moment you then talk to Companies Act, in Companies Act, it says registered valuers.
Yes.
In income tax, it says chartered accountant or say merchant banker. In FEMA, it says chartered accountant, merchant banker, or cost accountant. So there's multiplicity of valuation reports for one transaction. And the funny part is that Now, what is the expectation? Because in case a valuer gives a valuation, and that valuation is say 100 rupees, and the issue price is 102 rupees, so there will always be this taxation on that 2 rupees, because you can't have an issue which is less than 100 to comply with FEMA.
Okay, that clarifies.
So, Ankit, like in the case of non-resident investors, the present requirement is that a certificate would be obtained from a valuer, and that can be based on the uh, discounted cash flows. And it has been seen that if the premium which has been agreed between the investor and the investee is X, so the valuation report would also be kind of X. So now see, there was nothing in the Income Tax Act to challenge it. Now, like in case the non-resident investor invests in a company in India, and that is at a huge premium, the income tax department feels that this kind of an premium is not justified. Income tax department will appoint their own valuers, and they will get the valuation of the shares based on their own authorized valuers. Then the difference will be considered as income from other sources under section 56 to 7B. This is what I feel would be the impact of this particular change. Earlier, this was not available.
Assessments that we have seen, this was available, this was throughout, but the only change that is happening is that the non-resident is being added. This was always applicable. So with respect to non-residents, the only taxation ambit that was available to the income tax department was to say that this is unexplained money. They were not able to tax it under 56 to 7B, because they were saying that the investor has no KYC or has weak KYC, and rather this is something that is money which is coming, which is unexplained. It is because the source is not explainable. That was the presumption of levying tax. But anyways, we have seen a lot of litigation on this issue, and I believe this will not add to the ease of doing business, because in case you're talking about various companies who are only getting money from non-residents, so far they were legally out of bounds under 56 to 7B to be taxed for the investment that they're getting from abroad. And we have seen some lot of fraudulent, frivolous litigations from the income tax department on this account, because the income tax department and the assessing officers are not able to normally understand the kind of transactions that happen in the startup space. So they say that this is a loss-making company. How can you have a premium of 10 crores or 20 crores or 100 crores over this transaction? So this will definitely put back investment into Indian companies, and I believe that this is not a provision that, rather, my submission is that irrespective of how this will generate work for valuers, the idea is that this kind of taxation should only be limited where the income tax department is able to establish that the source of funds is not established. The market should be left to decide the fair value of investments. So
I think we should take some questions in case this is the last screen, as Mohit told.
So this is the only thing which I have to offer. So
there are some questions we can take, and for over 5 minutes.
Yes. So we have discussed amendment in 28(4) regarding cash benefit or perquisite. So this so Sagar ji has asked this. So there was this confusion in perquisite section, which it said that perquisite in kind. So that has been clarified that perquisite can be in kind or cash. That was the benefit then. So there it was not written that this cash is cash or this cash is actually check and other things also. That I believe there has been a clarification. So I think this is something that has been changed there. So parents can send money to, Devendra ji is asking, can parents send money to their children studying outside under education purpose? So I think the idea is that when you send money for education, we're talking about the education fee, the tuition fee, money that you're sending to the institution. But in case you're sending money for the stay of the children, I'm not clear if that will be captured under the 5% rule, 5% idea or the 20% TCS idea. It might be captured under the 20% TCS route.
No, I think this obligation for TCS has been given to the remitting bank.
Yeah.
Now the remitting bank will have their categories, under what category the money is being remitted. Is it investment, or is it medical expenditure, or it is tourism? So the remitting bank will ask for the category, and based on that category, the remitting bank will apply the TCS provisions.
Right. So, so then we have then there is a question from Mr. Ramana Murthy. Is there any restriction on number of homes owned by assessee before claiming exemption of long-term capital gain on shares invested to buy a home for self-occupancy? So 54F does put a ceiling of 2 houses. You can own one and you can buy the other, but you can't have more than one. So that has been there for a long time now. So that's already restricted. Yoga professional is a professional for presumptive scheme or not? They did add yoga professional as far as I remember, but I'm not very sure about it. I will have to check and come back. But I think they added yoga as a profession, or rather they've added yoga professional as a charitable activity, if I remember. So that has been actually added as a in GST it was added certainly. Yoga professional can Mohit, you
yeah, I think my view is you can treat them as an expert, and you can always take the benefit of the exemption.
So yes, I think so. 44 ADA.
The 44 AA, I think it defines the professions,
Yes.
and the professions are very, very clearly, in case we can see those.
It can be part of notified profession. We'll have to check if yoga professional is a notified professional or not. It doesn't really. We can try.
Yeah.
Under section 44 ADA income is only 26 AS income cleared shown. No, that is not the case. The duty of the assessee is to declare the entire receipt of his entire receipt, including cash or check. It is not concerned with 26 AS. There might be smaller payments which you have received where TDS is not applicable, but that is also supposed to be captured under 44 ADA. It is not limited to 26 AS.
Yes.
So one issue raised was regarding 44 ADA, and I think this is already taken care of. Then I think, let me see, which tax regime is better, old or new? So I believe for many, new will become better. But as we computed last year, that the threshold for deduction amounts to make new scheme better was 2,50,000 rupees. So now I believe that threshold will further increase, and it will increase to about 4 lakh rupees. I can come back with the exact number of that threshold of deductions for HRA, for interest payment on house loans and so on, which somebody should have to have a old scheme to have better taxability under the old scheme, but it will be a different case for everyone. So a specific comparison should be done for every case, in my opinion. Then loan write-off in IBC.
Also, please speak the name of the querist.
Sagar ji is asking that loan write-off in IBC, will it be now taxable under section 28(4)? And in Mahindra and Mahindra case, this was is that case now defeated? This is his question. So let me try.
Section 41 of the Income Tax Act is clearly saying that wherever the deduction has already been allowed for any expenditure or any losses, whenever those liabilities are not considered as payable, so remission of liability, rescission of liabilities, that would be taxable in the year the liabilities are remission or rescission. So there is no change in that. The taxability would be there, but this was not taxable under section 28(1), because the 28(1) is some kind of benefits that you derive out of your business or profession. Those are taxable, but the remission and cessation of liability is specifically taxed under section 41 of the Income Tax Act, and there is no change in that.
The 28(4) is very clear that what they have done is that they've substituted that section to say that the value of any benefit or perquisite arising from business or exercise of a profession, whether convertible into money or not, or in cash or in kind, or partly in cash and partly in kind. I don't think this affects the reversal of liability.
Yeah. What they have done, Ankit, for 28.4, is it not taxable now?
28.4, what they've done is they have simply kind of expanded the whole idea of how the perquisite, which was arising to somebody from business or exercise of a profession, was limited to kind. So now they have extended it to kind as well as cash or kind.
So this is rather enlarged.
This is, yeah, enlarge the perquisite, which is taxable in the hands of a professional under Section 28. They have enlarged it.
Right.
So what would be the capital earned? I think capital earned part we have already talked about. So Mohit, do you see any other question which we can take?
No, I think that's it. There were only 12 questions only.
So great. So thank you, Mohit, for joining us today, and thank you all our participants for your for coming in today and hearing us about union budget. And we will again take up a fresh new topic for next week and come back to you.
So thank you very much. I think the subjects that we are preparing now, one is the Supreme Court judgments on RDB Act and SURFACI Act in the year 2022, that is under preparation. Also, since we have seen in the proposed amendments in the IBC that the role of information utility is going to be very high, so we are also preparing a special webinar exclusively to explain the processes and procedures under the information utilities. Looking forward to all of you. Thank you very much. Thank you, Mohit, for joining the AAA webinar series. Thank you, Ankit. Thank you.
Thank you, sir. Thank you, Ankit. Thank you. Thank you, everyone, for listening us so patiently. Thank you.